We have our breakout. The markets broke through. I think everybody has noticed this breakout. Like it's been one of the most widely anticipated range breakouts that we've seen in a while. So can we now start backing up the truck, load up, and here we go towards the end of the year. So I'm going to break down what our expectations are, not just through the end of the year, based off of what we're seeing with the market forecast. I'm also going to break down the technicals from an aspect of what should we expect next week. Are we going to get follow through out of this, or are we going to get some backfill? And will that backfill mean that this is a fake out if we get it? So I'm going to break all that down in today's video and talk about what we can do with it, what's driving this price action. And then we're going to look at a value opportunity that was discussed yesterday as a long-term trade opportunity. Today we're going to look at its short-term potential. So let's go ahead and get started. Today is Friday, September the 6th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. Again, the intermediate line has turned up above 50. It broke out yesterday and is now up above 50 today. It's a good sign from a bullish standpoint of a new intermediate run starting. We don't have the moving average turning up yet. We'd like to see it turn up, and you're just probably another day away, depending upon what happens Monday, right? You're probably another day away from that happening, as long as we hold this gap that we broke out above. The near-term line's been up above 50 now for the, let's see here, it'd be 1, 2, 3, 4, 5, 6, 7 days. So that's a good sign for this near-term line. It is a higher near-term high coming off this bullish near-term low point. Market sentiment is still declining. It's still falling here, as you can see, but it's not. You can see how the decline is slowing. So much slower decline than what we had over here. Momentum line is actually down in the reversal zone. So again, like we had back here on this day, on the 3rd, this is again another, by definition, a bullish intermediate confirmation signal. It's not the strongest signal. It's stronger when you have the intermediate line already above 80 and the blue line below 50, right? So you're kind of set up for a new near-term rally. So we don't have that yet, but it still is, by definition, a bullish intermediate trend with no reversal momentum line. That's the bullish intermediate confirmation signal. This little breakout that we got, you notice, so I've got the orange lines here drawn. This is the Fibonacci. This is your typical 38 to 62% Fibonacci retracement zone. We hit the lower end of it and then bounced back up above. The dotted blue line is your kind of, it's not as strong because it's so big, but it's the 23 to 78% Fibonacci retracement zone. And you can see that we got into it, not surprising, and hit that middle one. And now we're back out above it. So we're back above the 38% line, which we had already been flirting with a few other times anyway. But this time we got back above the 23% Fibonacci retracement. We actually gapped up above it. So that's a good sign too, that this bullish trend can take hold and get going to the upside from a market forecast standpoint. So the market forecast is actually looking pretty good and bullish, with some expectations that this 1 to 3 month rally can start. And barring, considering that we've been on this market sentiment rally now for these 2 intermediate runs, that we could probably get a good, 3rd rally out of this in terms of like maybe a 2, 3 month, maybe even 4 into the end of the year, considering the seasonality of the markets to be bullish at this time of year. So good bullish, kind of, and again, if you thought, well, we just missed that breakout. No, this intermediate rallies last 1 to 3 months, so we have plenty of time for this to run to the upside. The one little red flag in terms of, are we out of the woods here? Are we done with volatility in September? The one thing that kind of stands out is the Russell 2000. It's actually still showing a pretty bearish pattern. It did not break out like the other indexes, and is showing us the light green shading with the yellow line. Now, in today's technical analysis class, I spent some time talking about how, the ideal scenarios, we want the Russell to, to show this bullish combination of dark green shading, green line at about the same time as the S&P. And it generally means if it lags behind, then that intermediate run usually is not a very good one. So if you want some color, more color on that, the technical analysis class that we offer is part of our monthly plus subscription. So if you go to our homepage and you click on this pricing at the top of the page, you'll see that our monthly plus subscription has the free trial. It does have the technical analysis class is part of that subscription. You do get a 30-day free trial on that, and it's $99 a month. So if you want to check out my class, you can sign up for this. There's also a link to it right above the video. If you're watching this on our blog, there's a link to it there. Again, it's recorded, it's posted, you can go check it out this weekend. So, and like I said, I spend more time, talking about the importance of the Russell at the least being coincident with the S&P in forming that bullish pattern. That's a little bit of a red flag for me, which tells me not that we won't get an intermediate rally at the end of the year. What it does tell me is it might not be right now. This might not be the breakout. And another thing I talked about too today is the more and more people see the same pattern, the less powerful that pattern is. So everyone's been expecting this breakout of this range that we've been in. How likely is that breakout to hold on this first attempt? Doesn't mean that it won't eventually break out, but on this first attempt, you might actually get a little bit of a sucker fake out before we get a little more bout of volatility. We've seen that plenty of times in a bunch of other patterns, head and shoulders, whatever popular patterns you see a lot of people talk about. And so that's what the Russell's telling me here is, because it's not close, right? The intermediate line, in fact, it slowed down today. Its ascent slowed down. It's not close to getting a dark green shading on its chart because it has to get above 50 for that to happen. And its market sentiment's falling below 50. So it's not, remember the S&P is falling up above 50, which is okay. And again, the near-term line is not in the upper reversal zone and had dropped into the lower half like the S&P. So we're not getting that good confirmation. Like I said, that pattern itself, light green shading and yellow line, is pretty bearish. It doesn't mean that it can't turn. It turned here, but it turned here well after the S&P did, and that turned out to not be that bullish of a run for any of the S&P or the Russell. And then before we had this bout, this pullback, this intermediate pullback. So so that's why I'm cooling off the jets a little bit. I've got the jets ready to launch off the runway, but I'm not quite ready to go full bore. I'm cooling off the jets just a little bit until I see more confirmation like this from the S&P 500. That doesn't mean I can't make bullish trades, as you'll see today in today's Market Outlook Live. We did at the market close today, which you also get access to with the plus subscription. We put on today's trade already, and it will be a bullish trade. So it doesn't mean we can't make bullish trades. It just means that I'm probably not going to back up the truck, and definitely not going to get rid of all my hedges that haven't been stopped out yet on this little breakout that we've had. All right, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when these videos are posted. Also, hit the thumbs up icon that's down below the video. That tells me two things. Number one, you like the video. You got something out of it. And number two, that you want us to do it again Monday. So it's our only way of getting feedback. We look at that every time. If you like these videos and you want to let us know that you want us to keep doing it, one click. Really easy to do down there at the bottom. Also, while you're down there, comment. What did you get out of the video today? Was there anything that stood out? Anything that you learned as you watch the rest of this? Make a note and comment down below as while you're listening as it comes to mind. Also, join our Market Outlook email list. There's a link popping out in the top right corner of your screen out there. Click on that link to subscribe to our list. Follow me on Twitter for more content like this in between the videos from day to day. And then join our Market Outlook community that we've created on Facebook. You can also join our Market Scholars community on our website. Again, here, if you're watching on our blog, it's right here at the top of the screen. Just click that blue button up there to subscribe for free to our website. You get access to our market commentary blog. You get access to our online community that we have, over almost 1,600 people, and it's growing every day. So We invite you to do that. Of course, when you're on the page, you can see our upcoming schedule of classes over here on the right. And again, there's our link to our market. I get asked this all the time. Where do you get to the Market Outlook Live? There's a link on the Market Outlook page right here in the top right corner, and it's also right here. So that's our trade review that we do every day. Every day that I do the Market Outlook, we review past trades from these videos, and then we put on today's trade before the market closes. We also invite you to engage with us on social media. We have today's Market Outlook tweet and Facebook post down here at the bottom. Again, the more you engage with these, the more likely Twitter and Facebook will put our content at the top of your timeline. If you don't engage, then you might not see our stuff. Not everybody who follows us sees our stuff based on their algorithms. So we try to make it easy for you. Just hit this little heart and then hit that like button. That will like today's Market Outlook tweet, and then click this image, takes you to your Facebook page, and then you can like and share that post there. And commenting is a good thing to do as well. All right, back to the charts here, and you can see on the long-term chart, look at the momentum down here. The long-term momentum between the 50 and the 200-day moving averages is rising, is building. In other words, the 50-day moving average turned up again, and it's rising, pulling away from the 200 days. So that's what brings this line up here at the bottom. It's all relative to the value of the 200-day at the time, so this is a really apples-to-apples comparison. If I were to put my cursor on today's value, again, you can see most of the time, especially throughout 2017, we actually have more positive momentum than this. So there's a lot of upside potential for a good run. Now, you'll notice this is the Hakinyashi candles. You notice that this candle has a long upper shadow, very similar coming off of a transition candle here, where we came down to the 200, the 50 was falling, and then we kind of broke above. Very similar to this over here, where we were coming down towards the 200, pretty bullish or bearish. We had a transition candle, and then this week of April the 16th, we had a week like we had now. Then we had a couple more transition weeks before we really took off to the upside. So if we were to go back to that week of April the 16th of last year, and I might have to go back, I'll have to go back 2 years here. So let me do that here really quickly. Oops, not 3, 2 years. If I go back to that week, and let me zoom in on it so you can see it. Here is the week of April the 16th. So you can see we had a little bit of a breakout from a sideways range then too. Had a nice good move, and remember we had dark green shading, just like we do now. It's a yellow line though, we didn't turn up. And then we came back into the range before we really took off to the upside. And here you had the dark green shading and the green line at the same time. If I were to look at the Russell 2000 in that same period, again the week of April the 16th of last year, you can see, again, nice good bullish move. The Russell actually participated and it pulled back, but then you had the intermediate run starting. So can we get this kind of we've had a breakout that everybody was expecting. Are we going to get some backfilling in this week? Are we going to fill in these gaps that we saw? And back into this area and fill back down towards this Fibonacci retracement zone to the top end of it this time? That could definitely be in the works. And it would not be a failure breakout. It will just be like we saw back in 2018 where we had a breakout that everybody was looking for. We got it. People might have priced in, they might have run ahead of it too much for whatever reason. And so we backfill and you kind of get some weak hands. And then we really get going for the rest of this year with this intermediate rally. So, can the intermediate run start right now? Sure. But I would not be surprised at all if we got that kind of move over the next couple of weeks, like we saw April 2018 with a similar Hakinyashi candle. Let's go to the 3 green arrow charts, and you can see we do have 3 green arrows. Moving average isn't rising yet, but we do have 3 green arrows. If you look at the 2-line versions, both the MACD's crossed above 0, stochastics is above 80. So, the 2 lines here are crossing above 30. I mean, that's really good. That's a good sign. So like I said, this very well could be the breakout move. If we hold this, more likely, if not Monday or Tuesday, we'll pull down towards this area. And if we do, and we hold this gap, then we're good to go. We'll stay above the 8-day moving average, and we are good to go. If we don't, we might, again, going back to that same time frame of a couple years ago. zoom in on April, the week of April the 16th. So that's the week of the breakout right here, and we finished. All right, looks like we finished this. So this was the next 2 weeks. This moved to the downside. These moving averages, the MACD did cross 0. The stochastics did cross above 80 on that breakout. You didn't quite get the moving averages crossing. And then we had this kind of a move back into this range. That's the kind of move that you can see the moving averages stayed above the 30. You see the 8 and the 17. The 8 crossed below the 17. That's what brought the MACD back down again. But not too deep. They both stayed above the 30, and then we took off. That's the kind of move I wouldn't be surprised. Again, because we get a breakout that everybody was watching for and got. Now we've got it, and now we might get some weak hands on any kind of what may look like a failed breakout on coming up here this week. All right, so now if we take a look at the intraday chart today, and again, that's kind of the thing I mentioned before. We got this 4-week breakout, and I actually, again, in today's class, I spent some time talking about a technical indicator that's really good at helping us identify the breakouts. Not just, see, it's one thing to get breakouts of a channel, but it's another thing to say, okay, well, how far away is the low point from the breakout in that channel? Because that's significant too. If the low point's over here and we're getting a breakout, that might be too much too fast, and it might not be bullish enough. Over here you can see that we are getting this low point further along this range. So again, that's the technical indicator I introduced today, because the pattern that we saw here in the S&P 500, if I were to go back on the custom time frame here, and let's go back to, let's see, 1, 2, 3, 4. Let's go back to the 30th, 5. Let's see, no, that would be because it's a Labor Day. 1, 2, 3, no on that. 4, 5 to the 29th. And then this one was August the 8th, is where the 20-day period started. August the 8th. Oops, right here. So we'll go back 1, 2, 3, 4, 5. I think this is the time frame. Yeah, here it is. So this pattern here, to get the high and the low, both the high and the low, the 4-week range, all the way on this side. So neither one of them are over here. Usually we're trending, right? Usually we either have the high, the low over here, and the high over here, or we have the high over here and the low over here, one way or the other. In this case, and we have both of them over here. This is an extremely rare pattern. In fact, as we saw today, this is the first time this has happened in the last since early 2017. 2017, we broke out to the upside and we never looked back. A little bit of a pause after the initial breakout, very similar to what we may get here. But then over the course of the next year, we never looked back. So interesting pattern developing. If I look at just a regular 20-day chart, you can see, there's our, very small range after the gap. You have to include the gap in yesterday's range. So we follow up a pretty decent range yesterday with very, very little, a complete inside day today. Complete inside day today. And again, you can see there's very little volume to the upside and there's very little volume to the downside. And so that, again, that makes this very susceptible to get filled in. And remember, if this gap gets filled in, this gap hasn't been filled in yet either. And that's why I think we might get a little bit bout of volatility before things take off to the upside, especially because we followed up this breakout with a completely inside day. And that breakout didn't really occur. Look at, we had a slight bump in volume, but as I tweeted out, we had multiple up days in this area inside of the 4-week range that had more volume than yesterday did. So not really a big up day in volume, and you can see there is some resistance in this area, and there's very little volume below. There's more volume above than there is below right now. That makes the path of least resistance back down into this area where my cursor is, the path of least resistance, right? So keep that in mind. Again, if I were to look at the 3 green arrow, the range, look, very unbelievably minimal range, and then the volume at 49.5 million shares. So if you look at that here in context, 1.3 is way down below the average. what was it, 49 million is way down here at the bottom end of the 52-week range. We are not below 1% yet, which that's when okay, we are really taking off. Like the intermediate trend will take hold at this point. We're not below that yet. And if you look at the volatility index, we are down to this 85% level. This can act not as strong a support as the 90%. You see we broke below that support, but it can act as a support, especially with the VIX right at 15. That can act as a support too. So are we going to break through these levels? Are we going to get into the lower half of this bullish range and really kind of establish ourselves? Because you can see when you do, if I were to go back 90 days, come back into this area, you can see that we never really got established. That was when the Russell 2000 didn't participate, it lagged behind. We never really got that bullish intermediate trend established with it following in those lows. Let's see if I can go out 180 days, and you can see over here, same thing with that first initial rally. We got down to the 85% level. We never did get any lows going. But if you go back in a full year, past that full year into 2017, you can see it. We did. When we were really bullish, we got below the 85% and stayed down there. So otherwise, we get to the 85%, we kind of languish around here. This is kind of where we hang out. And a little bit of choppiness here in this April timeframe. In fact, if I go back to the last April timeframe, so this is that week of April the 16th, we didn't quite get the volume down, and it got to the 90% mark and bounced back up. So, can this act as a support, and can 15 act as a support? Definitely. As you can see, last time we got over here, the first time we hit it over in this direction, we were already below 15. The first time we hit it on this pullback, on this intermediate rally, we were already below 15. We are not below 15 this go around, getting down to 85%. So a little bit of a divergence there that could cause a pop. Not to extremes, right? I'm not going crazy here, but could cause a pop up, probably up to this 18 level before we establish ourselves on a bullish run. All right, so to summarize, before we look at what's driving the price action, to summarize our technical outlook, we got a breakout that a lot of people have been waiting for. I mean, we've seen this. We've been in this consolidation for multiple weeks. A lot of people have seen the range. We got the breakout that was widely expected. That breakout was not necessarily the most bullish breakout. There are some red flags that suggest this might not be the start of the intermediate run. We might get, might shake out some weak hands first before and pull back a little bit and backfill in some of these gaps before we really get going back up to the upside again. So what do you think? Do you agree with that assessment? Do you disagree? There's a link right there popping out in the top right corner of your screen. You can vote, either agree or disagree. If you click disagree, comment down below. What are you seeing that either makes you a lot more bullish already, or what are you seeing that suggests that this is really a bear trap and we're really headed lower? Of course, everybody's got their opinions, but if you see something that drives that opinion, please share it down below in the comment section. All right, now let's talk about what's driving this breakout here. And you can see we started the week on the wrong side of the equation here, but a lot of it is because we started the week with almost a 4% drop in crude oil. That 4% drop in crude oil shifted to a 4.5% gain on the week in crude oil, at least in USO, by early Thursday morning. You can see the impact that had on stock prices, and since then, we pulled back from those highs, and stocks were unable to really get to new highs either. At least the U.S. stock. The emerging markets were strong this week. Developed markets outpaced the U.S. markets. But look at the week we had in small caps, not really outpacing. In fact, really a much smaller loss, much smaller gain on the week than what we had in the S&P on a relative basis. That's about less than half of the gains. On the other end of the spectrum, you can see TLT. We pulled back, yesterday at the open. Thursday on that breakout, right? Long-term bonds fell, gold fell. Gold continued to fall today, but not long-term bonds. In fact, if you take a look, see gold was one of the biggest losers. You can see small cap stocks also a loser today by the end of the day. And look at what the biggest winner was. In addition to crude oil, the biggest winner was actually long-term bonds. That's not really like breakout confirming pattern here. to see long-term bonds to be the big winner on the day, and small cap stocks down at the bottom with gold. Small caps and gold are really the two kind of together that did not perform very well. So a little bit of concern there in terms of how likely we are for that gap to hold going into next week. So not that it will guarantee that the gap will fill, but pretty decent odds based on what's driving this price action. Of course, the expectations of this meeting in October and things settling down in Hong Kong and the Brexit not being an issue anymore because they, kicking the can down the road a little bit longer. All those factors have seemed to quell any geopolitical issues. In fact, you can see the dollar, because all these factors overseas have calmed down a little bit, that's actually been a little bearish for the dollar. If I were to take a look at the two-line version here, or the market forecast on the U.S. dollar, you can see how we finished the week after breaking out above 98 and really getting to a good move. We came right back down. So we got light pink shading. We didn't quite get the moving average is still up. It's barely up, but it's still up, and we actually close a smidgen below it. So that light, the line will turn yellow tomorrow, and we have the light pink shading. So we've had that a couple of times here before. We got a little dark pink there, but we've a couple of times on this current bullish run we've had light pink shading in yellow. And we'll see if this one turns out to be any different. So far it's a little different because the near-term line's a lot lower than it was here, and for that matter here. By the time this near-term drop didn't get you through. This is the one. So this one's lower, and the momentum line is more extreme than what we saw. So a little bit of concern there on the dollar. But again, this is more of an issue, not of U.S. dollar, but because of what's going on overseas. The fact that, one of the factors that's really driving bullishness in the U.S. dollar is the wide gap between yields in the U.S. and abroad, especially in Germany, Japan. So as long as that wide gap exists, there will always be a draw. Might not be every single day, but there will always be a draw to the upside for the U.S. dollar. Yields finally had a good week until today. We actually had a nice, good bullish engulfing pattern on the 10-year note. You can see a little bit of we were getting a transition candle. If you look at the regular candle, well, we still ended up with the engulfing. So you still end up with the engulfing pattern. Not that this is like high probability bullishness, right? But that's a reversal pattern. We've seen this PPO is as low as it's been. There's only the other two times that we were even close to this low was back here, and you can see the rally we had off of that, and then right here, and we had at least a short-term rally. We retested lows, had another rally, and then we diverged to the downside. If I were to go back as far back as I can go on the weekly chart, you can see even beyond that, past 99. This is all the data we have for it, but nowhere even close to how strong a momentum we currently have. So this is actually really bullish, especially if I were to look at the linear regression trend line here. Right, where's linear regressions on this one? Right here, if I look at the TNX and I go back to 5 years, it's still extremely low. This is outside the second standard deviation channel with the ATR as high as it is. Just in fact, if I go back a little bit further, if I go back to the 10-year, not quite so much. And I think the 20-year is actually not so bad. The 20-year, you can see the trend that we're on. So, we can actually be more bearish. I don't think we will, but the 20-year linear regression, we're just barely getting to the midpoint. Now, that was a resistance over here in the past. So I actually do think that this midpoint will act as a support level and yield to a rally. So I do think the markets will be bullish going forward from here into the end of the year. Whether today is the day or yesterday is the day that starts that intermediate run remains to be seen. We might still get that backfilling where maybe the intermediate line pulls a smidgen below 50 before it really takes off again. But if it does or doesn't, we still have a good chance for intermediate rally and rise in yields associated with that heading into the end of the year because of how extremely overbought the safety trade has been. And so that unwinding of that extreme unwinding of the safety trade sets us up for some bullishness, a period of bullishness in equities. Not that the equities need it, because the economy is not really booming. The earnings aren't growing or expected to grow significantly, but it simply will just be an unwinding of the safety trade. Then, at the end of that intermediate rally where the safety trade is not so overbought, that might be your better time to start rotating towards safety in anticipation of what could be some weakness heading into next year's election year. All right, let's take a look at the sectors and how they're performing. And you notice, again, the sector selector has been updated. Brandon's updated it here tonight. So check that out on our blog. Just go to marketscholars.com, hit the blog here, and you'll see it here at the top. Scroll down a little bit. If you click on it, it will dive into these sectors. So you get the sector rankings here in the image, but of course you get a lot more detail in the actual post. So check that out there. But you'll notice here that our safe haven sectors have been so bullish for so long, they're so overbought, they look very different than the market itself, right? The market itself is, got a falling moving average. We just broke out. That's not the case for these three. In fact, they're pulling back. They were the big losers today until this pullback at the end of the day. The market kind of pulled back off of its highs, somewhat speaking, very small range, but at the end of the day, there was a little bit of a pullback, and the safe havens kind of rallied a little bit. But you can also see, too, look at technology, the breakout that occurred there. Look at the discretionary. Industrials, communication services all bumped up in the rankings, whereas healthcare stayed back. And, of course, financials trying to break out, too, but its moving average is really falling down. Some of these look like they're really close to turning over. Communication services already has. Discretionary looks like it's close, and technology is closer, and you can see their intermediate lines are, this one's above 50, 66, above 50 at 72, above 50 at 56, above 50. I mean, that means dark green shadings, right? Like the broad market itself. Healthcare is even above 50, but not financials. Financials still at 41, and these two are just struggling, and will continue to struggle if the dollar maintains its trend. Not the pullback that it's had, but maintains the actual bullish trend that it's been on. Energy's been down in this 12th grid for weeks and weeks and weeks. But you can see the healthcare is, it's been an underperformer. It's, while you'll have some leadership from these areas, your kind of underperformer flyer could very well come from this healthcare area. I wouldn't expect these two underperformers to take off to the upside. And these three up here, you wouldn't expect to really outperform either. So aside from some momentum trades here, and in terms of looking for some value opportunities, relative value opportunities in the short term, healthcare might offer us that opportunity. One of the names in that area that Brandon actually brought up yesterday for a long-term trade opportunity was AbbVie. I wanted to take a look at it today from a short-term bullish opportunity. If you take a look, it's got all the bullish factors. Of course, it's been very oversold, and that's where its valuations and yields are very attractive. But if you look at it, it's got the dark green shading. It will have a green line on Monday because the moving average has turned higher. So we'll have that bullish combination of a green line. Market sentiment's below 20, and that usually doesn't last for too long. You got a dark green shading and a green line. If you look at the three green arrows for AbbVie, we have three green arrows. And again, green line, right? So you'll have three green arrows. In fact, if you take a look at the two-line versions for it, you can see that both its MACD is above 0 now, the stochastics is above 50 and rising above its moving average too. Both the 8 and the 17-day are rising up above the 30-day. They've crossed above the 30-day moving average. You're getting a little bit of a breakout here. If you take a look at its Bollinger Bands, you're kind of at this point, this little volume node, the top end of this volume node, breaking through this node. Look how there's because of the gap, this big up and down move that was so rapid, there's very little volume in this area. So path of least resistance right now for AbbVie, because you got all this volume kind of below us here, the path of least resistance for the stock is now to the upside. And very little resistance all the way until you get up to around $80 a share. So there's opportunity. One standard deviation move to November expiration is only 74, but considering the lack of, you'd be right smack dab in the middle of that void. there's a very good chance we could fill that void very, very quickly. That's how gaps get filled very quickly. So, I think there's a really good short-term opportunity here. You don't quite have the DMI, not yet giving us a pattern, but the blue line is crossed above 25. The orange line's close to crossing below 20. That's the combination you like to see, especially when this gets above 30. The blue line gets above 30, and you get that bullish move to the upside. You can see from a long-term crossover, we're really, really lots of transition candles ready for a bullish candle to develop. In fact, if you look at next week's Hakinyashi, between the open and the close, you got 66.01 and 66.50 essentially. So that will put next week's open at 66.25 for next week's Hakinyashi open. We're already at 67.62. So you're starting out with a bullish candle next week, depending upon where we gap, if we gap. That PPO, if you look down at the bottom, that PPO is really bearish. Go back to as far as you can, back to 13. I mean, that's as bearish as it's been. Very, very strong, down to negative 10. Remember, this is on a relative basis, relative to the 200-day moving average. So, really good opportunity to fill in this gap between the 50 and 200. You can see the 200's at 77. So another sign that we could fill that void of volume very quickly and get up to that $79, $80 level. So we can come over here to the November call options and look at buying that at the money call here at 67.5. It's very cheap, and you put, put your stop order, you right click, buy custom with stop. You're about 270. So if you put your stop order at $1, 40-ish, that's about half of that 270. Put that at GTC, and then position size around that stop, that loss there. It is a speculative opportunity, so you don't want to position size with a full position, right? When you're speculating and on a directional trade, it's a low probability trade, but it's a high reward potential. In fact, you can see here, if we get to November expiration, we get up to that $80 level with a $13 gain from here, then you can see the Theo price will be $13 on a $2 cost. And of course, if it gets to that level anywhere before expiration, you can see what the Theo price there would be. It's really got some good opportunities really got some good opportunity here for some upside potential reward. Obviously, your delta would be so high, you're not getting very much extrinsic value change at that level at $80. So, I mean, that's a good level to get to. You get a good reward to risk ratio, considering you're only risking $140 per contract, and you've got the reward potential of about $1,000 plus per contract. You got about an 8-9 to 1 reward to risk ratio if it fills in that void rapidly, as stocks tend to do. Not just the volume void, but the void between the 50 and the 200-day moving averages. The other thing I wanted to mention too is on the Ichimoku cloud. It's gotten above it's been below the cloud, well below the cloud. It's gotten above its green Tenkan line, and now it's above its Kaijin line as well, and making its run up towards the cloud. Again, you get through that cloud pretty quickly. It means it can hold for resistance when you're still in the bearish trend, but can also change directions here. See if I can find a good a good example where you can get through that cloud and change trends pretty quickly when you've been relatively bearish, as you see here. Again, aside from some other factors as well. So again, small risk if the low probability trade doesn't work out, and really good reward if it does fill that void. All right, well, that wraps us up for today. You've heard from me. Now I want to hear from you. Use that link right there popping out in the top right corner of your screen. It takes you to our community on marketscholars.com, to our forums, where you can open up any new thread and ask any question or comment or post any comment you have on the video today. And let's keep this discussion going among other market scholars there over the weekend until our next video on Monday. So again, thank you very, very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon, comment on the video down below, join our community at marketscholars.com, follow me on Twitter for more content in between the videos. Have a great weekend, everybody. We'll see you all on Monday.